time says so. Okay.
So I could start sharing?
Yeah, please start sharing, and let's wait 1 minute just in case some late arrival. I hope that next year we can meet in person. My understanding is that's going to be, LATEA is going to be in Lima, organized by the Pacific, Universidad del Pacific.
Yeah, I think in person there are more people than online.
Yes.
Also, it's like a Friday evening, right?
Yeah, well, I mean, there is George Angrist after that, so I guess that he will draw some people. Okay, right. So I guess that we can get started. This is the session on financial institutions and corporate governance. The 4 papers are completely different. They have I don't see any connection really in the 4 papers. The first one is about government procurement contracts. The second one is about firms that compete to attract informed trading. The third one is impact of social unrest on stock market performance. And the fourth one is about monetary policy. I mean, I guess that it couldn't be more different. But anyway, so this is what the organizers decided. So let's get started. Natalia, the floor is yours.
Okay. Hi again. Today I'm going to talk about gender pairing. Especially, I'm going to talk about gender pairing in politics and in business. We already know there is a lot of evidence that, for example, in angel investing or venture capital, if women start their own businesses, then most of the capital, like investors, also coming from this, also female investors. What we would like to look at in this paper, but there are also similar links, but again, between politics and business. We also know there is an increasing trend in the number of politicians, especially in the US. So as you could see on my slides, it raised from 14% in the beginning of 2000 until 27% in 2020s. And what we also know that female legislators, they tend to focus on the issues like health or education, which is like commonly used to be more appealing and more going into the interest of female citizens. What we ask here, whether if a politician gets elected in a specific district in the US, whether she would affect the distribution of the government contracts, and we focus on the small businesses. To motivate it a little bit more, there is a couple of quotes from a senator, Jeanne Shaheen. First, she was actually a representative, and then she became a senator. But what she's saying, that women are at the center of the American economy. However, women entrepreneurs may be the country's greatest untapped economic resource. Also, female legislators, but also male ones, tend to include into their own web pages, they tend to include a specific one where each American citizen could fill in a form and ask for help to contact any federal agency. So these forms are going to play a role later, but what we are saying that politicians might transfer information from citizens to the federal agents who distribute these contracts, and like that, they tend to help particular citizens. If I don't have time to finish today, let me just briefly guide you through our paper and main findings. And of course, there is a lot of indigeneity issues, because it could be that at the same time, same district would be proactive and would have a positive climate for women in business and women in politics. So like just empowerment for female citizens in general. So to address this issue, we are looking at the close elections. So as long as a woman or man won the elections by not more than 5 percentage points, we consider this election as being as random. And what we find that just after the elections, if a female politician is representing a district, the amount of contracts which would go to women-owned businesses increases by 2.7 percentage points. As the next step, we look whether it would be in general beneficial or it could be detrimental for the economy, because it's just possible that female politicians, like women, they don't care whether these contractors of good or bad quality, they just give them contracts no matter what. However, we fail to find any evidence that these contractors are different. We don't see that female contractors are of worse quality, and we don't see that the contract performance goes down. And as one of the potential mechanisms, we look at the congressional communication. So remember, I just showed you a page that showing that politicians tend to contact federal agencies. What we did, we submitted around like 100 freedom of information requests, asking for these logs of the letters or calls between Congress members and federal agents. In this paper, we focus specifically on the Department of Defense for several reasons, especially due to the availability and data and the quality of the data. But this focus does not hurt us much because more than 60% actually of the sample of our contracts are coming from the Department of Defense. And what we find, if a female legislator is actively contacting these federal agencies, by actively contacting, we look whether she is more active than the previous representative, we find that the effects would be even stronger. Moreover, also the effects are the strongest among the local contractors. As long as a firm is having a contract in that district and also is registered at that district, the effects would be stronger. And also when a female politician leaves her office, and for example, even a male one comes, the effects are still there, so they're persistent. And we consider it to be that it could indicate some learning on the side of the agency. Okay, so what's the main sample? We look at the federal procurement contract. So it's the contracts at the federal level. It's an open source in the US. And we focus specifically on small business set-aside contracts. The reason why we focus on that, because more than 90% of women-owned businesses are small ones. So we don't want to compare apple and oranges. We also look at the contracts with pre-specified terms. So we already from the beginning, they know how long this contract would last, and they also know how much they would get for the execution of this contract. We also look at direct links. We look at the contracts awarded to firms, not to the parent or other branches. And the contract should be performed inside of the US and owned by the US companies and not some government entity or non-profit. The main independent variable or dependent, variable for us would be if this business is women-owned one. As long as more than 50% of owners are female ones, and moreover, daily operations should be also run by them, we consider these contracts to firms to be women-owned businesses, and it's also a flag in the system of the contractors. And then as a next step, we link the contract with the close elections. We use this place of performance in the district as a link between two. We focus on the US House of Representatives. The difference between a winner and a secondary runner should be not more than 5 percentage points. That allows us to show that to use this as random assignment. And what we find that we find 56 close elections in our sample. Again, it should be mixed gender elections, close ones. Exactly half of them are won by women, and we cover in total 7 congresses. Then we have a bit more than 30 unique contracts. We also check whether these contracts are distributed equally among a winning party or age or incumbent gender. We control for that, so our results are not driven by the, for example, that this woman would be just a Democrat, so we control for the party affiliation as well. Our main regression has a similar to a different GIF setup. Again, on the left-hand side, our main dependent variable, whether it's a women-owned business or not. And on the right one, we are most interested in this interaction term between female representative and after term start. So it means when she starts her business in the office, that will be after the term start. And we focus on that beta 3 coefficient. So what we find, depending on the specifications, the results slightly vary from 2.7 up to 2.8%. But we find that as long as a woman is elected in the district, the share of the contracts going to women increases by 2.7%. As you could see, we control for the year, election, fixed effects, also awarding sub-agency, two-digit product service codes. Actually, why do we don't control for the industry? Because it looks like it's misaligned in this data, and these two-digit product and service codes are much more accurate. We also cluster our errors, but the results still go through. Again, the next, you could probably wonder whether these numbers are big, 2.7 percentage points. Excuse me, okay. So what would be kind of the benchmark? Unconditional probability that a contract in our sample would go to women is 20 percentage points. Also, in our sample from 2002 until 2018, the share of contracts awarded to women-owned businesses increased by only 4.9 percentage points. So if you compare that with our effect, you could see that our effect is slightly bigger than half of the whole increase in the sample. If our sample could be specific, because we look at the women-owned small contracts, but again, if we look at the whole sample in general without putting any restrictions, then the number of contracts going to women in the US is only 7% on average during the last 20 years. However, the number of women-owned businesses is 1/3. So there is indeed a gap between women owning firms and getting the contract. What we also look at, there is a specific program which started in 1994 but started to be implemented only later in 2000, that at least 5% of government contracts should go into women-owned businesses. And this goal was only achieved in 2 years, 2015 and 2018. So there is indeed something going on. It's really for women that they don't get many contracts. Unfortunately, a drawback of our sample that we don't observe who applies for these contracts. We only see who got it, but we can't get this data about applications. What we also show that there is no bunching next to the threshold of the elections. It's assigned as random. You don't see that there are any jumps. We also look at the parallel trends, but today I don't have time to talk about it, but we don't observe the effect before she was elected. We also have different placebo checks. For example, we look not at the mixed gender close elections, but of the election of the same gender, but we don't observe the same results. We also move the date of the election to the previous or the subsequent Congress, and we don't find it. And what we also do, we vary a threshold of this close election. So we take the crazy one. So as long as he or she won by 50%, for example, so a strong winner, but we don't see the results. That was about the parallel trend I already mentioned. Again, we could show that if a female politician is elected, then the contractors become more heterogeneous. So there are more women, but it could lead actually to underperformance or overperformance as well, depending on what was happening before. I don't have time today to talk about all our checks, but what we look at the quality of the contracts. We don't see quality of firms. We don't see that female politicians choose smaller or less experienced firms. We don't see that. Then we also look at the contract terms. For example, it's possible that politicians start to give smaller contracts, and male-owned businesses are just not interested anymore in dealing with them. We don't observe that result neither. And here we specifically focus on the performance of these contracts. Again, it's not most of them not public companies, it's small businesses. So to measure the performance, we could look at the measures of renegotiations, which are used in economics and political science literature. So as long as there is a cost overrun, it means that, remember, we have predetermined contract terms, but then it becomes more expensive, or it takes a contractor longer to execute that, which is time overrun, it means there is something negative going on. We also look in general at the number of modifications of the contract and also whether the contract was cancelled. If you on the panel A, we have all firms, and besides that result, which is significant 10%, that there is slightly a cost overrun for all firms in general. We don't observe that performance get worse. And if we focus only on women-owned businesses in male and female districts, we don't see any difference in the performance. So what we claim that the performance, that the heterogeneity in the contractors doesn't cost doesn't lead to any cost in the performance. As a channel, we look at the congressional request.
Natalia, you have 5 minutes.
Thank you. Thanks. So we look at the congressional requests, and we look how citizens ask for the help in communication with the agencies. We don't look at the committees. I will later explain why. We look just at the individual oversight. And we expect the effect to be stronger for representatives that increase communications with the agency. We construct 3 different measures. The first one would be just about whether the politician is in general more active than the previous one in corresponding. And it doesn't matter what would be a topic of this letter. Then the second measure would be whether the topic was about exactly contracting. And the third one, whether it would be with the Department of Defense, the main office. Then we don't look at the sub-agencies. As you could see, all 3 measures go in the direction which we expected, and 2 of them are significant. And the strongest results would be that if they deal in particular with the contracts and with the Department of Defense. Just before I conclude, I would like briefly to discuss alternative stories. So maybe the first idea would be about thinking about congressional oversight through committees. For example, a female politician is sitting in an agricultural committee, and then the federal agencies which are under oversight of that committee would provide more contracts to women-owned businesses. Unfortunately, our sample is a sample of close elections, and that's why we don't have a lot of female politicians who would be in the strongest position in the Congress, who would chair these committees or being a second person in them. So there would be like more junior ones. That's why we don't have enough observations to show the results, and that's why we focus on the individual oversight, which politicians by themselves claim also matters, because they don't actually need to wait for any hearings, and they also don't need to go against other members in the party. They could just send a letter. The second channel would be network. So it's just possible that we just relabel existing effects. For example, there was a politician in the South Korea who was giving more government contracts to his friends. And it's possible also that female politicians just know more women in business relative to men, or like relative to male politicians, and that's why they just give the contracts to people whom they know. What we do, we check for the local links of that politician. So we look whether she was born in that district, whether she went to the school, university, or whether she was even whether she was business owner by herself. And we don't observe that our results are driven by these local links. Moreover, most of our sample are small businesses. So the effects that there will be that they would provide their contracts in order to get extremely high campaign contribution from some specific firms are quite limited, or will get some offers back. Also, we address the role model effects. I said that we don't see who applies for these contracts, and it's possible that female politicians could just lead to a change in behavior in the part of the women-owned businesses. So they just start to apply more, or they start they're just more women-owned businesses. What we do, we check whether after the election there are more women-owned businesses in this district, and we don't observe that. And we also check whether among female citizens in the district there are more business owners, but we don't see the increasing trends there neither. Then we also look at the changes in the composition of the contracts. For example, maybe in some districts, there would be more contracts going through the education, to the educational industry relative to some IT ones, but we don't see this misallocation, or not misallocation, but changes in these allocations. And we also look at the gender of the agency or sub-agency heads, because maybe if a leader of the agency is also a woman, maybe all results go through that, not through the politician. But actually most of the federal agencies and sub-agencies are led by men, not by women. To conclude, what we show that female representative cause an increase in government contracts allocated to women-owned businesses in their own districts. At the same time, the quality of firms and the contract performance don't get worse. There is no change in the contract terms. And we claim that individual oversight through congressional requests could be a potential mechanism, and that female representation can act as a supplement to dedicated programs like this 5% going to women-owned businesses. Thank you for your attention.
Okay, thank you very much, Natalia. Very nice paper. Now we have some these 2 minutes for questions. I mean, any question from the rest of the audience? You should. Okay. Well, let me ask you a question now. You only have 56 mixed gender close elections, so it seems like the database is not very large, and presumably most of these observations are closer to today more than at the beginning of the sample. Maybe not. I don't know. So my concern is that you're sort of assuming that the beta coefficient that you're estimating is the same from the beginning to the end. So presumably you take into account the increasing number of women that are allocated contracts over time through the time fixed effects, but maybe there is an impact also on the beta, that the probability that contracts are allocated to women is not constant over time, right? So.
Yes, so but actually I think you're right. What we need to show, there is increasing trend in the number of women in politics, but the number of contracts, it is kind of like oscillating, so there is not such a big increase. And we also cluster the standard errors, but I need to think more whether we could address it better, or we could also just maybe to look at the two at least intervals, right, time periods independently.
Well,
yeah.
Well,
Thank you.
I guess that's sorry. Yes. Annalisa.
No, I'm sorry. I was going to say that I had a similar concern as Rafael, but I was because you said that there is this growth in the number of women-owned businesses being given this contract, but then I realized that in your specification you have this a coefficient for just post-election period, right? So that should take care of this time dimension, and then this interaction term should reflect only the additional effect of actually having the women elected. I suppose.
Yes, but what could happen that we just have more also observations, and for example, if we don't cluster our standard errors, there would be overweighting on that. That the results would be just driven by the last years, but we also cluster for that. But I still need to talk to my also co-authors, and thank you.
Okay, well, thanks very much, Natalia. Now we move to the second paper. Annalisa, can you share your slides?
Sure. Great talk, Natalia. I'm sorry, I don't know why this, here it is. All right. Yeah. So thank you very much. It's a pleasure to present here at LACE Alumnes.
Annalisa, can you make it full screen?
Yes, of course. I'm sorry. There it is.
Okay.
Thanks, Rafael. So this paper is called Competing for Stock Market Feedback. It's joint work with Caio Machado from PUC Chile. All right, so this is about stock market feedback. So financial markets are known to provide good information about economic fundamentals, right? So the idea is that if we have many market participants holding different pieces of information and trading on this information, we should expect market activity to reflect average beliefs of people about regarding the profitability of these firms. But if financial markets provide useful information about the potential profitability of firms, you should expect firms themselves to have incentives to try to learn from financial markets to guide their decisions, to guide their investment decisions, right? And this is what has been known recently by feedback effects from financial markets. So one example that is very prominent in recent empirical papers is the reversal of mergers and acquisitions deals. So basically, there is evidence that sometimes firms announce a potential merger or acquisition, and there is a negative market reaction. And then if firms' stocks go down, firms back out of those deals. So basically, we think that owners and managers of these firms realize that maybe this is not such a good idea, and they give up this merger or acquisition. Okay, so basically, firms look at stock market reactions to news about their own firms, and they react to this information. So there is empirical literature documenting that actually firm managers react to what happens to stock prices of their own firms. And this is what has been known as feedback effects. So that I give a big picture of this literature in case you're not familiar with this. So in particular, there are some recent empirical and theoretical work saying that firms take actions to try to boost this informational channel, okay, to try to enhance their learning from financial markets, to take better advantage of this learning channel. In particular, there is this recent paper in the AER saying that following certain regulatory changes that increase the potential for learning from financial markets, firms adjusted their managerial compensation schemes as a way to take better advantage of this informational channel. So this is kind of a motivating evidence for us here. So there are also other papers saying that firms can take other measures to try to improve this informational channel. The basic idea in this literature is that firms can try to somehow shape their informational environment and take better advantage of this feedback effects for financial markets. So in this paper, we are motivated by two key observations. The first one is that obviously firms have their stocks traded in the same venue, right? In the same stock market by allegedly the same pool of speculators. And this is second observation is that these speculators have some limited trading capacity in the sense that there are wealth constraints, and there is also limited attention. So they have to decide to which stocks or to which sectors to devote attention to be better informed and to be able to make trading profits on these stocks, okay? So we should expect that more informed trading on certain stocks should mean less informed trading on other stocks. So what we're going to ask here is what sort of distortions could arise if firms have incentives to somehow try to attract informed trading to their own stocks. Okay, so there is this competition motive there. How does this competition motive affect the potential of financial markets to improve real efficiency, to improve decision making inside firms? So this is your sort of question you want to ask. So we're going to propose a model in which there are many publicly traded firms, and they have this potential to learn from their own stock prices. Okay, the managers can look at what's going on in the market to try to update their beliefs about the profitability of investment opportunities they have, which are uncertain. And on the other hand, we have speculators who are subject to some frictions, and they have to choose which stocks to learn about and which stocks to trade. So we have these firms that are going to delegate these investment decisions to managers, and they're going to offer these managers certain managerial compensation schemes. And they know that these compensation schemes are going to affect two things. Compensation schemes affect the incentives speculators have to this when they decide which stocks to learn about and to trade, and it's going to be clear why these compensation schemes affect these incentives, okay? And of course, managerial compensation schemes also affect the risk-taking behavior of managers, how much they are willing to take risk. So in a nutshell, this compensation policy is going to affect how managers react to market activity, okay, to what's going on in the financial market when they make these investment decisions. In practice, compensation schemes are going to work as a commitment device for firms. It is as if firms are committing to certain investment policies, and this is going to be clearer once I present the model. And this is going to lead to strategic interaction among firms, and this is what we're going to call competition for market feedback, okay? When firms set these compensation schemes, they're going to realize that this affects how much they are able to learn from the market, and they are going to have incentives to set these compensation schemes as to attract informed trading to their own stocks. So to give you a preview of the results, we're going to show that we're going to uncover this competition for market feedback, and we're going to show that this competition channel has the potential to completely shut down these feedback effects that are potentially good, okay? In the following sense, there is always going to be an equilibrium in which market activity, the activity in financial markets or stock prices are informative about the future profitability of firms, but this market activity is going to be completely disregarded by decision makers, okay? So although stock prices are going to contain useful information to guide real decisions, there's always an equilibrium in which managers completely ignore this information. So regulatory efficiency, which is understood in this literature as the potential of financial markets to reflect information useful to guide real decision, is going to fail to translate into real efficiency, which is actual improvement in firm value. Even if such a bad outcome doesn't occur, because this is not the only equilibrium in the model, we're going to show that in any equilibrium, this competition effect is harming real efficiency, in the sense that firms are going to offer compensation schemes that imply overinvesting, okay? So they're going to take excessive risk due to this competition effect. And I'm probably not going to have time to talk about points 3 and 4, but if you're interested, and if I just take a look at the paper, or we also show a couple of other results. For instance, we show this, what we call a commitment paradox, in the sense that firms would collectively like to agree to simply maximize shareholder value exposed. When it comes to it, after observing market activity, they would like to do what's best for shareholders. But the fact that they can delegate these investment policies to managers that works as a commitment device, this actually harms firms. So they would like to commit, not to commit. This is what we call a commitment paradox. And finally, we have an extension in the model where we allow firms to endogenously choose whether or not to go public. And we show that there is that too many firms are going to go public from an efficiency point of view, which would mean that there is a rationale for actually increasing the cost of IPOs in some sense, if these feedback effects are relevant. So for the sake of time, I'm going to skip this related literature slides, and I'm going to go straight to the model. So the model is the following. We have any number J larger than 2 firms. The cash flow of these firms, or the value of these firms, are going to depend on 2 things: on an exogenous fundamental that can be either high or low. The ex-ante probability of these 2 states is half, and this realization is an idea across firms. And firm value also depends on an investment action, which is either undertaken investment or not, 1 or 0. Okay, if investment is undertaken, which corresponds to action A equals 1. Firm value is going to be given by Vj equals, by V high, okay? If the state is high, and 0 if the state is low, okay? So firm value is state contingent if investment is undertaken. If investment is not undertaken, firm value is known to be V0, okay? So this is a risky investment opportunity that pays either V high or 0, as opposed to a constant value V0 of not investing. We're going to focus on the case in which this investment project is ex ante a good project. Okay, so this is a positive NPV project under the prior. This is for tractability because this is the parametric case where we guarantee uniqueness of the equilibrium in the trading stage. So we don't have to take a stance on equilibrium selection. At a previous stage, at an initial stage, we have some controlling shareholders that are going to decide on a compensation scheme for the manager, which is going to be an arbitrary function of this final cash flow, okay? And the these managers, subject to these compensation schemes, are going to observe what goes on in the financial market, update their beliefs about the probability of the high or the low state, and maximize and choose whether to invest or not, as to maximize their expected compensation. Here, I'm going to try to present it in the simplest possible way. So just consider the following. Any contract that is chosen, any compensation contract that is chosen by these controlling shareholders are going to imply some minimum probability of the high state that managers require to undertake investment. This is gamma J, okay? And more than that, we can define some cutoff X bar J, which is an increasing function of this probability gamma J, okay? Which we're going to call a conservatism measure. Basically, a certain compensation contract reflects itself into a certain conservatism measure. The more conservative the manager is, the larger X bar J, the less likely the manager is to undertake investment after observing market activity. Actually, this cutoff X bar J here could capture not only compensation policies, but other margins, other corporate policies, such as the choice of the firm's capital structure, whether to finance itself with more debt or more equity. Okay, but think of it as certain corporate policies that implies more or less risk-taking, more or less aggressive investment policies. And these controlling shareholders who decide on this conservatism measure or decide this compensation policy, they're going to do so as to maximize firm value from an ex-ante point of view. Okay, we don't have to bother on the details here, but this is basically the expected firm value. This is the probability of the high or low state, and the probability of investing or not conditional on the high and low state. This U lower bar here is the outside option of the manager, which is going to show up here. Moving on to the financial market, we have the following. We're going to model the financial market as a continuum of risk-neutral speculators with mass alpha upper bar, of risk-neutral sophisticated speculators, I'm sorry. So why are these guys sophisticated? Because they're going to be able to learn about first fundamentals, okay? Besides the sophisticated speculators, we're going to have some noise traders that are going to trade for exogenous reasons. And we're going to have a competitive market maker who's going to simply set prices in these markets as the expected firm value. After observing these compensation policies or these corporate policies in general, speculators are going to decide which stock to learn about. We have J firms, okay? So they have to decide which stock to learn about and how much of that stock to trade. It's not important that I'm restricting managers to learn about a single firm here. What's important is that they have some limits on how much they can trade, okay? So in the next slide, we're going to have some wealth constraints there. It's going to be clear. But for simplicity, we're going to assume here that speculators have to choose whether to learn about firm 1, 2, or J. Once they chose to learn about a stock, they are going to receive a message about the fundamental of that firm. Okay, this message can be either high or low, and this is an informative message about the fundamental of the firm. Once informed, these speculators are going to make trading decisions as to maximize their expected trading profits. Okay, so they can choose how many dollars to buy or sell, to use to buy or sell this firm stock, buy or short sell actually. And this is the expected trading profit. RJ is the dividend, and PJ is the stock price, which is going to be determined in equilibrium. Speculators have some amount of dollars to devote to trading, so they have some wealth constraints here, and they have some short selling margin requirement. Think of it this way: you cannot have $0 and short sell $1 million of a certain stock, right? You have to have some amount of money to be able to either buy or short sell stocks, and so they have limits on how much they can trade, either buying or selling stocks. And as I said, we also have noise traders. We're going to model noise here as a random order NJ for stock J, drawn from a normal distribution. So the total order flow for a certain stock is going to be this YJ here, which is the sum of all sophisticated speculators' orders plus noise traders' orders. And this set omega J, we're integrating these orders here, is simply the set of speculators who chose to learn about stock J. Okay, and we're gonna denote by alpha J the mass of speculators who choose to learn about stock J. So market clearing is as follows. We can denote by this YJ here, both YJ.
You have 5 minutes, okay?
Oh, okay. Thank you, Rafael. So basically, given these aggregate orders, the price is going to be set by the market maker as the expected value of the dividend. Summarizing the timeline so that you have the big picture of the model, contracts are offered, speculators make their learning and trading decisions, all speculators and noise traders submit these orders, market maker executes these orders, managers observe whatever happens in the financial market and makes investment decisions. The equilibrium definition is standard perfect Bayesian equilibrium, and we restrict attention to equilibria in which firms make symmetric decisions on their compensation contracts. And then I can jump straight into the main result here. Basically, managers are going to choose to invest after observing aggregate orders, and relabel here aggregate order by this variable xj, think that this is just an increasing function of yj, okay, previously defined. So if there's a lot of buying pressure, managers decide to invest because prices go up and they're optimistic about the firm's fundamentals. If there's a lot of selling pressure, prices of the stock are low and they decide not to go through with investment, okay? So the more aggressive managers are, which means investing for lower cutoffs xj, the larger the probability of investment, this increases incentives to trade, because information that speculators possess about the firm is information about the profitability of this investment opportunity. If this opportunity is not likely to be undertaken, this information is useless. So there's no potential for trading profits, okay? So this is why this conservatism measure of the manager implies more or less aggressive trading of this stock. And so the first main result we have is that there is always an equilibrium in which all firms are going to choose compensation contracts that imply that managers will always invest regardless of market activity. So this is an extreme equilibrium in which financial market information is completely ignored by firms, even though market activity contains useful information. So the stock market is going to be revealing good information about the firm's fundamentals, but managers are going to be ignoring this as an equilibrium outcome. So a key theoretical insight here is the following. So if we have many papers about stock market feedback that talk about the decision of a single firm, okay, in isolation. And if we had a single firm here, this firm would learn as much as possible and use this information as well as possible in equilibrium. If we move from one firm to as little as two firms, we have a dramatically different equilibrium outcome where there's no learning whatsoever. So this is the first key theoretical insight that we have. So considering that stocks are traded in an integrated financial markets can lead to dramatically different outcomes compared to the simplification of considering a single firm in isolation, okay? And from an empirical perspective, a key insight here that maybe empirical papers could build on is that even if you observe low investment sensitivity to stock prices, this doesn't mean that this feedback channel for financial markets is not important for firms. Quite on the contrary, maybe this feedback channel is important and firms are competing to attract informed trading, and this is the precise reason why they are not benefiting from learning from and reacting to this information coming from financial markets. So if I still have a minute, I'm just going to mention that this is not the only equilibrium in the paper. There is another equilibrium, what we call a good equilibrium, even though it's still inefficient, where the equilibrium is not so dramatic in the sense that there is learning from the market and managers take advantage of this learning channel from financial markets. But this equilibrium is still inefficient in the sense that compensation contracts are going to imply overinvestment and are going to imply that managers are taking too much risk. But there is still some learning from the market. Okay. Rafael, I guess I'm out of time, or how am I doing?
Well, you're basically out of time, so
Okay.
maybe you want to go to the end, and if you have some concluding section to.
Sure. I'm just gonna jump to conclusion here. I had a jump to conclusion button here. All right, so just to sum up, we propose this model where we have multiple firms trying to take advantage of this learning from financial markets channel, but this competition to try to attract informed trading to their own stocks may actually eliminate the potential of financial markets to improve your decisions. So not reacting to stock market is a possible equilibrium outcome, even though financial markets are providing useful information about firms' fundamentals. And then we have a few more results in the paper. If you're interested, I invite you also to check our working paper. Thanks.
Okay, well, thank you. So we have time for one question. I guess that I can jump in, being a theorist myself. I mean, I'm kind of I mean, this is a very puzzling result. So one has to go through the details of the model to really understand it. But one thing that strikes me is that you refer to learn and trade. You allow for short selling. So somehow the trading may reveal that this particular firm does have bad prospects. So you should basically not invest. I mean, there is this association, in what I gather, of learning, trading, and good news. But learning, trading may be bad news. You may be short selling, and right?
Sure. No, you're absolutely right. So yeah, unfortunately, I didn't have time to explain much the intuition. So for this result, but going straight to your question, here you can learn this bad news. So imagine that a lot of people short sell because they observed bad fundamentals. Then the manager is likely to observe low aggregate orders and give up investing. So definitely the firms are going to also benefit from learning that they should not invest. This is actually what takes place here. So so there is learning in both directions. So the thing is that when they don't learn, since this project is ex ante a good project, a positive NPV project, if they don't learn anything, they go on with investment. But of course, in equilibrium, they, in principle, managers could learn and give up investing, and this happens in the other equilibrium that we have in the paper. But the key intuition for this puzzling result that firms ignore market information is kind of a rat race, which is similar to firms undercutting each other if this was price competition, you know. So basically one firm wants to be more aggressive than the other to attract more informed trading, but the peer has the incentive to undercut this firm and be either more aggressive, and they keep doing so until no one can learn anything. So this is a perverse equilibrium in this sense, to give you a short picture of the intuition. Thank you for the question.
Intriguing result. Okay, so can you
Sure. Stop sharing? Yeah.
Yes, stop sharing. Good. And now we move to the third paper. Maria Bondar, can you upload your presentation? Okay. So can make it full screen if you can.
Sure. Could this one more? Okay, so great.
Good.
So hi everyone again. I'm really happy to be presenting this project. So my name is Maria Bondar. I'm a PhD candidate from Goethe University Frankfurt, and this is joint work with my colleagues Philippe, Sophia, Mali, and Denise. And the title of our project is Pricing Protest: The Response of Financial Markets to Social Unrest. So the question of or the problem of social unrest becomes more and more relevant. So just between 2016 and 2020, the fraction of countries with major social unrest events has more than doubled. And when I say social unrest event, I mean events such as protests, demonstrations, and riots. So I want to motivate our paper a bit. So here I'm showing you two pictures from social unrest events. So the left-hand side picture is other protests that happened in Chile in October 2019, where people started protesting against increased subway fares. On the right-hand side picture, you see the so-called Yellow Vest protests that happened in France in November 2018. So both of these social unrest events were relatively big. So they started in the capital, but then they spread out through the whole country. They were long-term and they were widely covered by the media. However, the stock market reaction to these events was markedly different. So what happened in Chile, right at the announcement of state of emergency in Santiago on the 18th of October, the stock market index was decreased. And over the 2 weeks or 3 weeks after the beginning of protests, lost more than 10% of its value. However, we don't see the same pattern for France. So as you can see, around the date of the beginning of social unrest, there seems to be no particular trend. So if anything, the small decrease in the value of the stock market index started already before social unrest. And if anything, sometime after the beginning of the unrest, the decline in the value of the stock market index was much, much smaller. So this brings me to our research question. So in this paper, we want to answer the question, what are the effects of social unrest on stock markets across the world? And also, what kind of factors could explain the differences in reactions across different countries? In this paper, we make several contributions. So first, we introduce a new media-based measure of social unrest. We call it Daily Social Unrest Index, which is based on daily media coverage of social unrest events. So in a nutshell, we apply textual analysis techniques to identify articles in major news outlets that are related to social unrest. We count the number of these articles daily, and this is the basis of our daily social unrest index. We further use this index to conduct an event study with this daily high frequency data. So basically, we compare the stock market returns right before and right after the beginning of social unrest. We use a big cross-country sample. specifically include 156 events that happened across 72 countries. On the one hand side, it gives our research results internal validity and also combined with high frequency data. So we are fairly certain that the effects that we're identifying are actually causal effects. At the same time, having this big cross-country sample with multiple events and multiple years gives our research external validity, which is beneficial when, for example, compared to existing literature that usually concentrates on a particular case study. How do we measure social unrest? So we use the data provided in the previous work of one of our co-authors. So we use the data from Barrett et al. 2020 to extract the month of social unrest event. We then use this information combined with the number of articles to compute our social unrest daily index, SUKT. The numerator of this index, XKT, is simply the number of articles about social unrest in country K per day T. The denominator of this formula is the pre-event average number of articles related to social unrest. And this denominator serves to control for any sort of media bias, which could arise simply because some countries are covered by the media more than the others. We then use our daily index to identify the exact date when a social unrest event began. Specifically, we say that the beginning of the event, or day 0, is the first day during the event month when our social unrest index exceeds its country-specific mean by more than 15 times. This is a rather strict threshold. However, in our paper, we of course conduct robustness checks and show that our results are not sensitive to the choice of the threshold. I will briefly show the confirmation of the validity of our identification strategy. So here you see our social unrest index averaged across all the events in our sample, and you can see the mean and the median of this index around day 0. And of course, as you can see, the index is around 0 right before the beginning of social unrest. We also use our social unrest index to identify the end of the event. So this is the last day of a series, which started at day 0 when our index is above 1. Or in other words, when the number of articles related to social unrest is above the pre-event average. And based on these two dates, we can identify, or we can compute, the duration of social unrest event. So this is simply the number of days between beginning and end. And we use the measure of duration, we interpret it as the measure of severity. So the longer the social unrest event, the more severe it was. I will very briefly show one of the validation exercises that we conduct in our paper. So here I'm showing you the social unrest index across 4 events that happened in South America in 2019. The red line is the date of the event as identified using our index. The blue dashed line is the date as identified using some external sources. And as you can see, the two align pretty closely. So this gives us the confidence that our social unrest index, in fact, identifies precisely the beginning of social unrest events. We conduct more of these validation checks in our paper. Briefly about the methodology. So as I mentioned in the introduction, the main methodological instrument in this paper is the event study, which is the standard approach to evaluate event effects. Specifically, we're going to compute abnormal returns using the market model. In this paper, we're also going to apply the regression approach. So it has some benefits compared to the event study. Specifically, it allows for clustering, it allows for heteroscedasticity and autocorrelation adjusted standard errors, and it allows for alternative dependent variables. So in some specifications, we're also going to look at the effect of social unrest on trading volume. However, the main purpose of this regression approach is that it should serve as a robustness check. So of course, both methodologies should deliver the same result. And the general assumption should hold for any method. And this assumption, this identifying assumption, is the event date is correctly identified and it was not anticipated by the market participants. Specifically, we follow a big literature in that we're using the market model to compute abnormal returns. How does this work? So first we estimate equation 2 for each event I in our sample, in which we regress stock market returns of a given country's index on a market index. In our baseline specification, we're going to use the MSCI index. And we run this regression on the pre-event period. So for the days -50 to -11 before the beginning of the event, so in the normal times. We then compute abnormal returns for the event period, which is simply the difference between actual observed stock index returns and the returns as predicted by the market model. We then aggregate these abnormal returns across all the events in our sample, and finally compute cumulative abnormal returns between day 0 and day tau as simply a sum of abnormal returns over these days. So this is all pretty standard and widely used in the literature. Our regression is also rather simple. So this is, we're estimating equation 6, where the dependent variable RIS are the daily returns of stock index I on day S. And the main explanatory variable is dummy, which is equal, dummy unrest, which is equal to 1 for the days within the event windows. So in our baseline specifications are event windows 3 and 7 days after day 0, including day 0. So the coefficient of interest is beta 1, and it's supposed to measure the average stock market returns during the unrest period, so during the event window, compared to all the other days in the sample. In this regression, we also include control for a time trend. We include country fixed effects and day of the week fixed effects. And we use heteroscedasticity and autocorrelation adjusted standard errors with LEG2. Now to the main results. So this is one of the major takeaways of our paper. So here I'm showing you the average cumulative abnormal returns, where the red vertical line is day 0. These returns were calculating using the market model, using the MSCI index as the market index. As you can see, social unrest leads to a decrease in stock market returns. So over the 2 weeks after social unrest, after day 0, the cumulative abnormal returns dropped by 1.4 percentage points. So this effect, first of all, you see that this decrease is statistically significant on the 95% level over all the period that we observe. So, however, this effect is not only statistically significant, but also economically meaningful. So the probability of observing such a decrease in cumulative abnormal returns in normal times is only 5%. So this result is equivalent to the 95th percentile. You see that this several facts stand out from this picture. So first of all, even 25 business days after the beginning of social unrest, there seems to be no reversion back to 0 of the cumulative abnormal returns. So this seems like a very persistent effect, and it also looks like a level effect. Second of all, this effect is robust, so it doesn't depend which index we use in the market model. It also doesn't depend on which methodology we use to calculate abnormal returns. And it is also, of course, confirmed by our regression results. Finally, but also importantly, we can look at what happened to cumulative abnormal returns 10 business days before social unrest event. And as you can see here, there seems to be no pre-trend. So before the event, there is nothing going on. Cumulative abnormal returns oscillate around 0. So this gives us additional confidence that our identification strategy works and the market participants did not anticipate social unrest. This is, of course, the average effect. So in order to try to solve the puzzle that I presented to you in the motivation, we need to dig a bit deeper and conduct some heterogeneity analysis. So first thing we look at is the effect by duration. So we split our sample of social unrest events into 3 groups based on the duration. And as you can see here, so this green line here are the long-term events, so those that last for more than 7 days. And these are the events that are mainly driving the average effect that we observed before. So if we concentrate on the effect of long-term social unrest events or the more severe social unrest events, then these kinds of events lead to a decrease in cumulative abnormal returns, which is very high in magnitude, so around 8 to 10 percentage points decrease in cumulative abnormal returns. And this effect is also comparable to what was observed in the literature for particular case studies, such as, for example, Arab Spring. We also look at the effect by country income groups. So we split our sample of events into 3 groups based on country income. And again, we observed that our average effect was driven mainly by a particular group of countries, specifically by low-income developing countries and other emerging economies. At the same time, there seems to be no effect in the advanced economies. So social unrest seems to not have any effect on the stock markets in advanced economies. Finally, and probably most importantly, we look at the role of institutions. Specifically, we look at the role of...
You have 3 minutes. I missed 2 minutes. Okay.
Okay. We look at the quality of institutions and we split our sample of countries based on the Polity score. So as you probably know, Polity score is measures the level of democracy in the country. So high Polity score means that the government regime is more democratic. Low Polity score means that it's more autocratic. And here again, you can see as before that our average effect was driven mainly by one particular group of countries, specifically by those with below median Polity score. So it seems that social unrest affects the stock markets in countries with weak democratic institutions. We also look at alternative measures of institutional quality, so using World Bank governance indicators, for example. And again, we see the same picture if we look at the dimension of voice and accountability, which is similar in interpretation to the Polity score. So we also observe some effect along the dimension of regulatory quality. So our results suggest that social unrest, that democracy, civil freedoms, government accountability, quality of private sector regulators, these are the factors that shape the stock market reaction to social unrest. Since I'm almost out of time, I just want to give you some intuition why is this the case. So our hypothesis is that uncertainty is an important transmission mechanism. So we believe that in countries with better developed institutions, more democratic institutions, these institutions are more flexible and more robust and are more able to aggregate divergent views without having any major implications for economic activities. However, in countries with weaker institutions, this is not the case. In countries with specifically with weaker democratic institutions, social unrest is a challenge to the system of the governance itself. And in these countries, investors and market participants are uncertain in terms of how the social unrest is going to be resolved. So we believe that uncertainty is an important channel, and I'm going to show you 2 pieces of evidence that are consistent with this hypothesis. So first, we observed that following a severe long-term social unrest event, stock markets experience an increase in trading volume, and this increase is quite significant. So trading volume increases goes up by almost 30 percentage points during the first 3 days after social unrest event. According to the market microstructures theory, this suggests this is consistent with the uncertainty explanation. And final piece of evidence, which is of course not conclusive, but we are also for a particular case study, for the case of protests that happened in the US in 2020, we look at what happened with the volatility index VIX, which is traditionally used in the literature as a measure of uncertainty. And we see that following the beginning of social unrest, there is a delayed reaction of the volatility index. So it seems that even in the US, social unrest led to an increase in uncertainty. Just to sum up, in this paper, we found that social unrest events decrease stock market returns. We found that cumulative abnormal returns decreased by 1.4 percentage points over the 2 weeks. We found this effect to be robust and persistent. We found that it is driven by severe events, that it affects emerging economies and low-income developing countries stronger, and finally, that the quality of institutions matters a lot, and that strong institutions mitigate the negative effects of social unrest. Finally, we suggest an explanation and our hypothesis is that the transmission channel is the increase in uncertainty. Thank you.
Okay. it's a very interesting paper, right? So questions that you may have?
I have a question for Maria.
Yeah.
Maria, I was wondering about your severity duration measure.
Mhm.
I was thinking that if you have thought about, I don't know if you do that, it's, I don't remember exactly the details of your definition of severity, but when you say that it's this dummy 0-1 for continuing in this social unrest is being above this historical average by more than 15 times, right?
Mhm.
So when you do this is only considering this episode, right? So imagine that you have in a certain country a social unrest that lasts 10 days. This enters the historical average throughout your sample, or are you restricting, or are you considering historical average the period before the beginning of your sample? I ask that because, for example, being in Chile here, after, let's say, the first 15 days, maybe you had a decrease in the number of news and you are no longer within this social unrest period, but in 2 weeks, you may be back in social unrest and compared to the before the previous social unrest period, but now that the historical average has gone up, maybe it's more difficult to consider it a social unrest again. I don't know if I'm being clear, but I think you.
Okay. So I have, my answer to this would have 2 parts. So first of all, this criterion, this 15 days, right? It's not used to, so it's used to identify the beginning. So in the case, so first of all, I don't think that we have cases like this when social unrest goes, I mean, there were, I guess, cases like this, but they probably wouldn't enter our sample when social unrest events happen, months after months. Because in this case, we would identify maybe the first event, but not the consecutive events, right?
Exactly.
Because as you say, you could bias the average. So in this case, we would probably only identify consecutive events that were if the article number would go, skyrocket high. There is a potential selection there, but I think it's in very rare cases, for example, for maybe the Arab Spring events, when it was such a long, continuous process that maybe we wouldn't identify all these cases. But we also checked that our results, for example, hold if we exclude these kind of events. So, for example, we excluded Arab Spring events completely from our sample, and we get the same results. So I think that this is not a major issue. Another issue, so another part of my answer would be that there is maybe some bias in the duration measure itself. So for example, maybe there was one social unrest event, we identified the beginning, then the number of articles decreased, and so we decided, okay, it ended. But then there was another sort of outbreak, and the number of articles went up again. So that could be the case. So maybe our, but if this is the case, then our duration measure is in fact, underestimated. It's a lower bound.
Exactly.
So this could be the case, but if it is the case, then our effects are probably the lower bound.
Exactly. Yes, that's what I thought. I thought that maybe you could define this historical average as the sample historical average. I mean, maybe throw away a piece of your sample and analyze the second half, let's say, as an additional robustness check, and then you can only look at events that happened, fixing this historical average.
I mean, we could, I guess we could check something, how many events do we not select because of this issue? I guess we could look into the selection. Yeah.
Okay, I think that Maria, can you move your slides away, and then I will share my.
Oh, I'm sorry.
Right. Okay, so this is the last paper of the session, and is joint work with my colleague David Martinez Miera. Now, this is about how interest rates affect financial stability. And so what we do in the paper is we focus on risk-taking by banks using a simple theoretical model, which is based on a paper that we published in Econometrica in 2017 entitled Search for Yield. Now, in a competitive setting like the one that we had in Search for Yield, what we call the conventional prediction obtains, i.e. lower safe rates lead to higher risk-taking. So low rates are bad for financial stability, especially when, according to the empirical work that has been done on this matter, they are kept too low for too long. No, so the question that we address in this paper is what happens when we introduce market power. So the way in which safe rates affect bank risk-taking is they have an impact on banks' funding costs, and they have an impact on loan rates and intermediation margins. And when monitoring incentives depend on margins, the incentives to external monitoring depend on how profitable this is going to be. This is going to have an impact on the loan's probability of default. So why is competition relevant? Well, because it affects the pass-through of funding costs to loan rates, and therefore it affects the margins and the monitoring incentives of banks. So that's the story in the paper. Now, the model is silent about what drives the changes in the safe rates. It may be real factors, the famous savings glut, or maybe monetary policy. What we do in the paper is analyze the effect of an exogenous increase in real safe rates. Now, the model set up, just to have a brief preview of the results, is as follows. We consider a market in which banks compete à la Cournot. The competition is therefore measured by the number of banks. If n is equal to 1, you have a monopoly. If n is large, then we are approaching perfect competition. The banks are going to be raising funds from uninsured risk-neutral investors. So these investors require a given return R0, which is the safe rate. And these banks are going to be monitoring borrowers. Monitoring reduces the probability of default of their loans, but it is costly and it is unobserved by the investors. Remember that these investors are uninsured. And so we have a moral hazard problem, right? So the main result of the paper is that higher risk-taking, lower safe rates lead to higher risk-taking in competitive environments. This is the conventional prediction. But if you think of an environment in which banks have significant market power, the result reverses, that lower safe rates actually make banks safer, not riskier. So the risk-taking channel of monetary policy reverses sign when banks have significant market power. So this is the main result. Let me illustrate that by reference to this picture. In the horizontal axis, you have the safe rate. In the vertical axis, you have the probability of default of bank loans. And the different lines correspond to different number of banks. The dark blue is n equals 1 is a monopoly. This dark red is the n equals 10, which is actually very close to competition in the Cournot setup. Now, you can see that the slope is positive when you have n equals 1 or when you have significant market power. The slope is negative when you have competition. This is the conventional prediction. What we show is that, well, I mean, it depends very much on how competitive. Now, notice something that is also well known. An increase in the number of banks increases the probability of default. This is the famous Sherpa value effect that has been studied by many people before. So let me, before I sort of go a little bit on the model, let me present to you some suggestive evidence, which is as follows. Now, I want to look at the sensitivity of loan rates and intermediation margins to changes in the federal funds rate. This is US data for different deciles of banks' market power. So following the famous paper by Drexler, Szabo, and Schnabel, we divide banks into 10 bins from the lowest to the highest value of the Herfindahl index. So high Herfindahl means lots of market power. And we estimate with quarterly data for banks in each bin this regression, where this is either the loan rates or the intermediation margins, and the coefficient, the parameter of interest is the beta I, how sensitive it is, this variable to changes in the federal funds rate. Now, the data is coming from core reports for the period 94-2018, and the data on banks' market power is FDIC data on county-level deposits at bank branches. So the picture that you get for loan rates is as follows. Remember that this is monopoly, this is competition, right? And you know that the sensitivity is lower for high market power. So it is much higher, the sensitivity for competition than for monopoly. Perhaps the more interesting result is when we look at the margins, because here what happens is that there's a negative sensitivity for high market power, i.e. when you have a lot of monopoly power, then you increase the federal funds rate, and what happens is that the margin goes down, right? As opposed to what happens, because remember that this horizontal line at 0 separates positive from negative sensitivity. So negative sensitivity for high market power means that high interest rates are bad when you have high market power. for margins. Low interest rates are good, and therefore this is what corresponds to the result that I illustrated in the first few slides. So the summary of this evidence: higher federal funds rates implies higher loan rates, lower sensitivity for high market power, and higher margins for banks in competitive environments, lower margins for banks in monopolistic environments. So this is something that broadly corresponds to what we produce in our model. So, okay, so this is the basic setup. Let me just move to the, I'm not going to say very much about the literature. There's a huge literature on the risk-taking channel of monetary policy. It's mostly empirical. There is also a larger, even larger literature on bank competition and risk-taking. This is one of the famous papers in this branch. Not many papers on the intersection of the two. So, in our paper, our main references are earlier work on which we built. So the paper has an initial section that presents the Cournot model of bank competition and risk-taking and where the main results are obtained. And then we look at either alternative competition scenarios, when, for example, the banks compete with market finance, what happens when you have heterogeneous monitoring costs of bank entry. And we also look at alternative funding scenarios, what happens if we replace the uninsured by insured deposits when the banks compete also on the deposit market, and what happens when banks have capital and therefore leverage is an endogenous parameter. Now, of course, here I'm not going to talk about any of these extensions, so I'll just focus on the basic model. The setup is as follows. We have two basis static model. There are three types of risk-neutral agents: entrepreneurs that have projects that require bank finance, banks have to raise funds from uninsured investors, and investors require an expected return R0, the safe rate. The entrepreneurs have no money, they have no wealth, and they have ideas, risky projects that require a unit investment at T equals 0, and the return is stochastic, can be success or failure, capital R or 0. And with these probabilities, what are these probabilities? P is a probability of failure of this project without monitoring, and M, which is a number between 0 and P, is the monitoring intensity of the lending bank. So the more you monitor, the lower is going to be the probability of failure, the higher the probability of this getting this success return. Okay, so monitoring reduces probability of failure. Now, there are three assumptions that we're going to be making on the entrepreneurs. The first assumption is decreasing returns to aggregate investment. If you invest a lot, there's going to be a lot of output coming from this market, and the price that this output is going to get is going to be lower. And the second assumption is that there is a single aggregate risk factor. So this implies that if you have a given amount of monitoring in the market, you are going to have perfectly correlated project returns. This is an assumption that is not particularly realistic, but has been used before in this literature, and it simplifies considerably the analysis. Finally, the third assumption is the free entry of entrepreneurs. They are going to enter the market until the success return is equal to the loan rate. Because that generates, if the success return is higher than the loan rate, more entrepreneurs are going to be entering the market. Given this downward sloping relationship, in the end, you are going to get the only stable continuation when this equation obtains. And therefore, R of L is the inverse loan demand function in this market, which is something convenient when you're working with a Cournot model. The banks, there are n identical banks that compete on a Cournot. The strategic variable of bank J is lending LJ to entrepreneurs. The total amount of lending is just the sum of the LJs. And we also have three assumptions on the banks. The first assumption is that banks have no capital, so they are entirely funded with uninsured deposits. And there's a section in the extensions that deals with the case where banks can raise equity capital. The second assumption is that bank monitoring is costly, and for the numerical assumption, we assume a monitoring cost function which is quadratic. This simple specification. So gamma is the parameter that captures the cost of monitoring. And finally, bank monitoring is non-contractible, so there's a moral hazard parameter in the banks that choose the monitoring privately, and the investors that, of course, care about how much monitoring banks do. The structure of the game is as follows. Each bank is going to set a supply of loans, LJ. then this is going to determine the total supply of loans and the loan rate, RL. Then at the second stage, the bank offers, the bank get now how much lending, but it has to raise the funds from the investors by offering an interest rate BJ. And finally, once the funds have been raised, the bank is going to choose the monetary intensity MJ. So this is the structure of the game. Now, as you would expect, the game is solved backwards, stages 2 and 3 first, and then we move to the Kuno competition stage 1. There is no strategic interaction in stages 2 and 3, so the problem is the same for all banks. Once I know the size of my loan portfolio, then I have to go to the investors and I have to choose my monetary intensity, and there is no interaction. So everything that happens in stages 2 and 3 depends on the L chosen in the total amount of lending in the stage 1. So I can write the borrowing rate as a function of L and the monetary intensity also as a function of L, without having the J's, because all the banks face the same kind of problem. Okay, so the bank's choice of monitoring for a given borrowing rate P of L is going to be the solution to this problem. You maximize with respect to the monetary intensity. This is the probability of getting R of L. You have to pay the investors P of L, so this is the intermediation margin. And this is probability of getting the intermediation margin minus the cost of monitoring is the problem that we have to solve. Then we have the investor's participation constraint, which is satisfied with equality, no restriction on that. This is a probability that the investors are going to get B of L and has to be equal to the opportunity cost of their funds, which is R0. Okay, so here we have two equations, this one and this one with two unknowns. The solution is going to give the B of L and the M of L, which is proposition 1. Now, it's important to note that if you look at the problem that the banks are choosing, are solving, they maximize, this is the expected payoff, and you have to subtract the cost of monitoring. Now, the first order condition, if you differentiate with respect to M, you're going to get the intermediation margin minus the marginal cost of monitoring, which is given the quadratic specification, gamma M. So monetary intensity is proportional to the margin. So whatever happens to the margin, this is going to determine the risk of the bank's portfolio. Now, to analyze the Kuno equilibrium, then it is convenient to compute bank's profit per unit of loan just by substituting into the expression that we have before the solution for the ML and the B of L. And asymmetric Kuno equilibrium is just a value of the individual lending, such that if all the other N-1 banks choose L star and you choose LJ, the best thing that you can do is choose exactly the L star here. Right? So this is a fixed point in this mapping. And so equilibrium total lending is going to be the sum of the lending by the N banks, so it's just N times L star. Okay. So the second proposition that we want to show is that, not very surprising, a decrease in the save rate leads to an increase in total lending. So lower rates are always expansionary in this kind of setup. And the third proposition is the most important proposition, is that it says that under monopoly, a decrease in the save rate leads to an increase in monitoring and a decrease consequently in the probability of loan default. So lower rates are actually good for stability because they incentivize the monopolies to exert more monitoring effort. On the other hand, in the competition, a decrease in the save rate leads to a decrease in monitoring and increase in the probability of loan default. So this is the negative slope that I mentioned before. So you have positive slope in monopolistic environment, negative slope in competitive environments. So what's the intuition for this result? Well, this is important to sort of go back to the literature on the pass-through in Kuno oligopoly. With competition, lower costs have little impact on margins because margins are basically zero, right? They are not zero here because banks have an incentive to keep some margin equilibrium in order to be able to monitor impaired loans. But loans rates are very sensitive to changes in the save rate, and therefore margins are low. And in fact, margins you can show that they go down with lower costs. So you have riskier banks. On the other hand, with monopoly, lower costs have large impact on margins. So remember, if a monopolist, you have an input that whose price goes down, the monopolist is going to be very happy. The margin is going to go up, and you're going to have safer banks in this situation. So, and finally, you have the traditional charter value result that competition is going to increase banks risk-taking. Okay, so so the novel result in the paper is that when you have a low competition, the lower rates are going to decrease banks risk-taking, which is the novel result. Okay, now there are some testable implications that you can follow from this analysis. For example, if you have on the left-hand side some measure of risk, for example, something like non-performing loans. Now, this part is the charter value effect. You increase market power, you reduce the risk. The beta 1 will be negative. This effect is if the HHI is 0, if you have competition, this term will disappear, and then higher interest rates are going to reduce risk-taking by banks. This is the conventional wisdom. But on the other hand, you would have an infraction term here that says that, well, if you have sufficient degree of market power, then this effect that comes from here may be reversed because the beta 2 is positive. So that would be one way of testing the implication of this paper. Now, there are more other testable implications that have to do with the extension that I mentioned before. There are possible nonlinear effects of direct market finance that would generate a U-shaped relationship that would need to introduce a quadratic term here. Then the proportion of insured deposits would also have an impact on risk-taking, and the impact is in fact positive. And finally, the effect of stock market trading, i.e. access to the equity market, would generate a negative effect of higher rates. And this is through the results on the leverage of the banks. So this is basically what I have to say. And I guess that I should stop sharing and see how many people stay here. And okay, that's it. Any comments, questions?
Thank you. I have a quick question. So when you talk about these insured deposits, is it a choice of a bank, or is it like capital constraint? So it's like I could see that now capital constraint on the bank, which leads to higher risk taking.
No, I mean, the existence of deposit insurance is something that comes from the regulation. And of course, nowadays, we have, in sort of, at least in developed countries, very significant amounts of deposit insurance following the global financial crisis. But the marginal euro or dollar or whatever, or peso that banks have typically comes from uninsured sources. So there is a fraction of your liabilities that is insured, but there is another fraction that is uninsured, and therefore, at the margin, we thought that it would be sort of more realistic to consider the uninsured case as the benchmark.
Thank you.
Okay.
Rafael, could you just briefly expand a little bit on the intuition? It's quite nice. I like very much the paper. Just to understand a little bit better this effect of increasing monitoring. So is it that monopolists have more room to reap the benefits of increasing monitoring? I didn't understand why. I didn't quite get the intuition for this increase in monitoring
now
for a monopolist versus in other competition. Thanks.
Okay, the perfect competition is the standard result that people have obtained mostly in empirical papers. Our econometrica paper is one in which there is some sort of theory that rationalizes this empirical result. But the intuition is actually very simple for the monopoly case. Now, consider, I mean, forget about banks. Consider a monopolist that is selling some product and is sole seller of the product in the market and uses some input into that product. I don't know, maybe, I mean, if the cost of that input goes down, right, the monopolist is going to maybe reduce a little bit the price in order to increase the amount of sales. But in principle, you would expect that the margin that the monopolist is going to get is going to be higher, right? So the the pass-through is not very intense in the case of monopoly, and you're going to have higher margin. The monopoly is very happy with lower cost of their inputs. Now, in the case of a bank, the cost of the input is what you have to pay the depositors, the investors for their funds, and therefore lower rates are going to increase margins. And in a model in which margins determine the monetary intensity of your lending, then this is going to increase monetary and reduce the risk. So that's the story. It's easy for the case of the monopolies. It's a little bit more complicated in the case of the competition. Okay, listen, it's 8:45. I think that there is the keynote speech by Josh Angrist, and I think that we should stop now. Thanks for your session.